You have a nice pad and the wheels to go with it. So now you're investing in your health and have taken up mountain biking. But you could probably buy another house with what that bike is costing you. The things you own are your assets. When you refer to your assets, it's anything of value that can be converted into cash. And unless you are a long-lost family member of the Motsepe family and about to come into some money, chances are that most of your assets are too big and expensive to buy outright, so you take out a loan and pay it off bit by bit. So this brings us to one of the most important concepts when you talk about money, namely interest. What is interest? It's simply the cost of renting money. When you rent a car, you go to a car rental company. They give you a car, and when you give the car back, you pay them a fee. The same concept applies to money. If a bank lends you, say, 1,000 Rand, this is called the capital amount. They expect to get the 1,000 Rand back, and on top of that, they charge you a fee for borrowing the money. This fee is the interest you pay. Why do they do this? Well, the bank could have done something else with the 1,000 Rand they're lending you. For example, invest it somewhere else. So this is called opportunity cost. The cost of not being able to use the money somewhere else, and you're paying for it. It's important to remember that when you take out a loan, for example, a mortgage loan, you're expected to pay back both the capital amount plus the interest. So, early in repaying your home loan, most of your repayments go towards paying off the interest, and only when it is paid off, then you start making significant contributions towards repaying the capital amount you owe. So how do banks decide what interest rate to charge you? They decide by determining the risk. Say you have 100 Rand and two friends want to borrow it from you. Becky, you are sure, will pay you back immediately, even as quickly as tomorrow. The risk of lending him the money is low, and you are 100% sure you'll get the money back. Unfortunately, with your friend John, you never know. It's 50-50. You might never see your money again. So he is a high risk to lend money to. Now, when a bank considers lending you money, one of the things they look at is your credit record to tell them about the risk they are taking in lending you money and the likelihood of you paying them back. If you have a high credit score, it means you are good at paying back your loans and you're considered a low risk. And when they lend you money, you'll be getting a low interest rate. But if you have a low score, it means that you might not be as diligent as you should be when it comes to paying back money you owe. And therefore, you're a high risk. And if the bank decides to lend you money, the interest rate will be high. Interest rates are controlled by central banks worldwide. In South Africa, our central bank, the Reserve Bank, can raise the interest rate as it does from time to time. It can also lower the repo rate, which is the rate the Reserve Bank lends money to commercial banks. It is also sometimes referred to as the base rate. We all know that banks use the money that they have on hand to make loans to other bank customers, and that the money you deposit in the bank does not actually stay there but goes back into circulation. However, if you were to go into the bank tomorrow and withdraw your entire account, would the bank have enough cash on hand to pay you and other depositors? But by law, banks are required to maintain a certain percentage of their deposits on hand, and this is called a bank reserve. So if the bank runs low on reserves, they borrow money from the Reserve Bank. Banks then add about 3.5% on top of the repo or base rate to make up for their own costs. This is known as the prime rate, and the bank will lend you money at prime plus or prime less. In other words, a percentage above or below the prime rate, depending on your risk profile. So the golden rule remains, where possible, only spend the money that you own. But if you must borrow money, make sure you never miss a repayment and pay it off as soon as possible. To win with interest, try to save instead of borrow. So remember, assets are anything of value that can be converted into cash. Interest is the cost of renting money. If you are high risk, it means the bank will likely charge you a high interest rate. But if you are low risk, you will likely be able to borrow money at a low interest rate. The repo or base rate is the rate at which the Reserve Bank lends money to commercial banks.